If you're trading options or just holding ETFs, you might be wasting your time. I'm here to hopefully show you that achieving financial independence through stock market investing is easier than we make it out to be. New stock trading apps like Robinhood and Webull are amazing and make it easy to put your money to work for you, a critical component of building wealth. But without guidance, if you don't know what you're doing, you risk losing that hard-earned money. Or worse. This news story caught my attention. It's a really unfortunate situation of a young man who found himself in the middle of a complex stock trade he probably shouldn't have been making on Robinhood, and he ended up taking his life because he thought he was in debt over $700,000. And I get it. If you're young and eager to start making money, there's a fire hose of information out there and a lot of enticing get-rich-quick schemes. It's hard to make sense of any of it. The traditional financial advisors tell you to buy and hold ETFs for a 7% return. But plug that into an investment calculator and the results aren't exactly inspiring if your goal is financial independence. On the other extreme, you have people like Dave Portnoy pumping up the popularity of day trading to his young, impressionable fans. But 80% of day traders quit within the first year, and day traders, on average, lose money. There's an interesting research paper that goes further into this. I'll link it in the description below. What I've learned along the way is that we don't have to wake up at ridiculous hours of the day poring over graphs and candlesticks. No one has time for any of that. Due to shifts in market trends over the last few decades and change in how brokerages handle stock purchases, we can actually find impressive returns of 30% or more each year with a relatively simple investment strategy. The strategy we'll be using isn't new or highly sophisticated. It's how the world's wealthiest people have been amassing their fortunes for years. Now we're going to do it too. We're going to focus our strategy on buying industry-leading growth stocks. See, a company that can show repeated market growth commands a higher stock price. As that stock price goes up, the stock generates higher returns for its investors. But direct ownership of these high-growth stocks has been unattainable for the average investor. Here's an example. Let's look at Alphabet. Think back 5 years ago. If you had purchased Alphabet at the end of June in 2015 and held it until now, you would have seen a 117% return, nearly doubling your money. But that assumes you had $657 to invest in a single share back in 2015. What if you only had $100 to start investing with? Your next best option is finding an ETF under 100 that carried Alphabet. By owning a share of that ETF, you effectively own part of their stock, right? Well, let's look at the performance of some ETFs that carried Alphabet. We've got F.I.R.E, a fidelity ETF focused on communication companies. 21% of the portfolio is made up of Alphabet. In that same 5-year time window, it returned 27%, 90 percentage points less than Alphabet. It even underperformed the S&P 500. What about another one? Vox, a communications ETF from Vanguard. 20% of this ETF is also allocated to Alphabet. How'd they fare? We can see they only generated a return of 4% over 5 years, 1/10 the performance of the market during that same time. But just in case you're not convinced, let's look at one more example. Amazon. This time we'll look at popular Amazon-heavy ETFs first. A quick Google search, we can find FDIS, XLY, and VCR. Okay, they're generating a very respectable 50% return from these ETFs. Not bad. Now, how did Amazon do over that same time frame? Just wait for this, because it blew me away. 400%. You couldn't afford to buy Amazon 5 years ago, and you bought one of these ETFs hoping for Amazon-level returns? You missed out on 350 percentage points. But traditional thinking would guide you to buy the ETFs instead, particularly considering Amazon is currently trading for over $2,600, more than most people have in their bank account. Now don't get me wrong, there are better performing ETFs out there, but the level of research you have to do to find those is pretty much the same research you could do to find individual strong performing growth stocks. Thankfully, we can buy these high growth stocks through the advent of fractional shares. It's a relatively new offering, but it's a big deal. Fractional shares let us purchase a portion of the stock we want for the amount of money we have instead of limiting us to the actual price of a full share. But those percentage returns from the stock's performance still get passed through to us. So our $100 might only buy us a piece of a share of Amazon, but if Amazon goes up 10%, our $100 investment goes up 10%. Now rewind that if you need to. It's an important idea to understand because it's a big part of how we'll execute our investment strategy on this channel. I thought people might find it interesting to see how you can use this approach to build a market-beating stock portfolio. I'm going to build a growth stock portfolio and show you my results each week here on YouTube, the good and the bad. I'll reinvest on a weekly basis and share my decision-making along the way. My hope is that for someone out there, this serves as an example of how you can generate substantial returns in the stock market without taking excessive risks or wasting your time in vehicles that are not going to give you the returns you're looking for. So let's get started. First, we'll go to M1 Finance, an investment platform and brokerage that specializes in fractional share investing. You can also do this with Robinhood, Fidelity, Interactive Brokers, or Schwab. I like M1 for their user interface, and some other features we'll cover another time. So, create an account and log in. I already have my account set up. The process is simple and straightforward like any other brokerage account. Now I've funded the account with $100. This is the minimum required to start an account, and it's also 10% of the median weekly income for a US worker. Remember, our goal is about making investing approachable, so I want to show what the average person can do with just a little bit of their money. We'll be investing $100 today, and then another $100 every week, each Tuesday, here on this channel. Now let's talk about our first companies. Principles around the companies we'll be choosing. For some context, we're starting this journey a few months after the 2020 market crash. The global economy is still in the midst of recovery. So, we want companies who were market leaders before the events that led to the crash. We want companies that fared well during the regional shutdowns. And we want companies we believe are positioned to benefit from any changes in consumer behavior as a result of those events, thinking forward about 3 to 5 years. I've chosen 5 companies today. Collectively, the 3-year performance of these companies has seen returns of 185%. They have recovered almost 40% since March's market crash, outpacing the Dow and the Nasdaq. More importantly, I'm confident that each will fare well in our near-term future too. Now let's finally get to our stock picks. The first one I like, and I'm sure it's of no surprise, is Amazon. They're a behemoth. Many will say they're overpriced, but I think those people are using old models and not accurately pricing in growth momentum. The second one is Alphabet, for similar reasons. Next, we also have Netflix. The cord-cutting movement was building rapidly before 2020, and I think recent events have only increased the demand for streaming entertainment. This next one's going to be a bit different, as it's not a tech company, but is in a great position to grow if regional shutdowns return. They are a leading manufacturer and distributor of spices, specialty foods around the globe, and they saw a sales spike the last 2 quarters. That company is McCormick Foods. For diversification, let's pick up some healthcare stock. Teladoc Health saw a big spike during the recent world events, and I think they are poised to continue expanding into the telemedicine space. We'll go into more nuanced analysis in the future. For this episode, I just wanted to introduce the series and share the 5 companies we're going to start our portfolio off with. Remember, we're building a smart growth portfolio starting with $100, and we'll be investing another $100 each week. We have now added these 5 companies to our portfolio, and our trades are set to execute at tomorrow's market open. We'll check in next week and see how we did and invest our next 100. Thanks for watching. If you found this video interesting, hit the like button. Also, feel free to share your thoughts in the comments. If you want to join us on this adventure, hit the subscribe button. We'd love to have you. And if you want to get notified when we post a new video and add new stocks, make sure to hit that notification bell. Thanks a lot. Have a good week. Be safe and get invested.